Hello and welcome to SwitzerTV Investing. I'm Peter Switzer. This goes out every Monday night on our own YouTube channel. Look, just go to Switzer Financial Group. On tonight's program, we have Michael McCarthy from CNC Markets and Julia Lee from Birmingham Invest. And I've got them to talk about media stocks that they like. But we all know that the media industry is changing. Free-to-air is challenged. We have all these challenging organisations like Netflix and Prime and Amazon and all of them coming along. Where do we invest going forward in this really interesting sector? Then Charlie Aitken comes on and he'll give us his best idea for investing in the media, as well as he gives us a really interesting local stock that he thinks has a real chance of making a big rebound. So you don't want to miss that. And finally, Anthony Doyle Fidelity gives us his view on how you can invest in Asia, which is pretty relevant considering that a trade deal is likely, I think, before Christmas. That's the show. Without any further ado, let's go to Michael McCarthy and Julia Lee. As usual, I'm interviewing Charlie Aitken, and I want to talk to him about what we've seen go on with Donald Trump and Hong Kong, and we're awaiting a China reaction. And some people are asking me, should they hold back investing? I want to talk to Charlie about timing the market or timing the market, something he wrote about in the Switzer report. Charlie, thanks for joining us.
Yeah, always good, Peter.
Let's start off with the controversial issues. Some of our clients have asked us after reading something I wrote, well, in the sense I wrote, I don't know what China's going to do to react to Donald Trump supporting the Hong Kong protesters, but it could slow up or jeopardise a trade deal. What's your reaction on that?
Yeah, well, look, probably just another negotiating tactic from Trump. He's all about full pressure all of the time. Yeah. And I think it was nothing more than that. It was a piece of legislation that would have gone through anyway. He didn't have to sign it, but he did. Yeah. The markets on Friday didn't really care that much.
No,
they're off a few basis points. Yes, it was shortened because of Thanksgiving. Hong Kong's up today.
Yeah.
The Hong Kong share market's up. Yeah. You know, most of the leading stock shares are up. And look, I think we are heading to that phase one deal, but it's probably in the market anyway. Yeah. And I don't think that piece of legislation is enough to derail it. You've got some sort of, you've got a bit of noise out of China, but I don't think it's enough.
Okay. So let's talk about, because you wrote about it in the Switzer report, talk about timing the market and timing. Now, you're a fund manager, and in a perfect world, it's great to be in the market, but the buy in at the lowest possible price and ride it up. But your argument is basically timing the market's more important than timing.
Yeah, look, I think very few people outside of some technical analysts who are quite good at it are actually good at timing the market. But timing the market assumes that you've got sort of no percent or 100% of your money in it all the opportune times or not. I think that's highly impractical. Most of us are terrible traders. It's actually quite hard to buy when it's, when there's blood in the streets, and quite hard to sell when it's euphoric. And look, we did some, as I wrote in the Switzer Super Report, we looked back over the last 15 years and simply analysed what your returns would be if you'd missed the 5 best up days, the 10 best up days and the 20 best up days. And they're materially different outcomes to just being invested all the time and taking the ups and downs.
So if you're invested all the time, what kind of expected return did you get compared to if you missed the best 5 days because you didn't know when they were coming?
The market return for the 15 years in the MSCI World Equity Index that I follow, that has benchmark, was 7.1% compound per annum. Good return. Yeah, it's okay. Fine. Better than cash. Better than everything else.
Better than term deposits.
Better than a term deposit. But if you missed just the 5 biggest up days in 15 years in the index, your return dropped to 4.8%. If you missed the 10 biggest up days, it dropped to 3.5. And I think if you mixed the 20 biggest up days, it actually dropped to less than inflation. Quite amazing.
Right, so in your lifetime, have you missed big days? Not to say that you weren't or an investor, but have you been surprised? That's probably the better question. Were you surprised what days actually ended up being huge days?
Yeah, well, they usually come after some big negative event or big, obviously a period of weak sentiment. You can even look at very recently, in August, we were getting a lot of questions from investors about, this looks terrible, markets are breaking down, technicals look bad, China and America aren't getting on, or the US reporting season looks bad, inverted yield curve, one of my favourites. Where's that today?
Yes, right.
And here we are.
It's uninverted, by the way.
It's uninverted, yes, whatever that word is. Here we are, 3 months later, Wall Street's up 11% from the middle of August, right? You have missed an 11% return, which is more than the average compound return over the last 15 years. So if you'd panicked in August and sold or sold out completely of equities, you've missed almost a year's annual return in 3 months. So look, For me, that was a recent example. I think that there's very strong arguments for being invested in great businesses all of the time.
Yeah.
It also comes down to portfolio construction. So you don't want a one-way bet on technology or one-way bet on resource stocks or one-way bet on banks, or have some diversity, have a bunch of different sectors that perform a little bit differently, and have some defensive stocks in your portfolio.
Yeah.
But I think with interest rates at basically zero, there's an argument for being fully invested all of the time at the moment, for sure.
You would have noticed, because you and I have talked, and you would have occasionally read me, I guess, where I often have said when it seemed like the market had overreacted, I've often used the term, let's buy the dip.
Yep.
And until I'm really scared that the market is getting close to a really scary point, I haven't changed my attitude.
Yeah.
Is that a reasonable strategy? Like, if you think you're hitting a scary moment, reducing your exposure. Like, for example, there have been times when I've been 100% exposed to the stock market because I had total confidence. But if I start getting a little bit toey, or in your own case, do you ever sort of say, okay, I'm 100% invested, but now I'm going to go to 70% because
I would never go to 70%. The most cash I'd generally run would be 10%.
I meant 30%. Yeah. I meant 30%.
Yeah, I know is the answer. I think there's always defensive companies I can buy that would protect me, or something else that would protect me in that environment. I think particularly now with central banks just taking interest rates to zero and quantitative easing back in the game again, I think most dips are a buying opportunity. I think it's what you've got to condition yourself to, Pete, is the scarier the headlines, you must think, what am I going to buy? It's almost, I haven't done it for my fund, but it's like Westpac right now. Every single headline is negative. The CEO's gone, the chairman's going, the shares are down 13%. They've had a capital raising that's everyone's underwater. Your chances of making money from here are high, in my view. Now, it may not be tomorrow, it may not be next week, but if you bought some Westpac shares over the next month or so, I don't think in the long term you'll do too badly. But you've got to peak by that sort of peak of corpse kicking, which happens in Australia more than any other market. But it happens around the world too. So I think that judging the press and thinking, I've got a little bit of cash, I'm going to spend it because the margin of safety is there. And something like Westpac, I actually think the margin of safety is there.
Okay. Are you toying with the idea of buying some Westpac?
No, well, we run a global fund, so the answer is no. I leave Australian stocks to Australians broadly, but. In my heart of hearts, would I think something like Westpac is a capitulation buy? Yeah, I do. But I just remind you that everything in the markets now is so media driven, so Twitter driven, so headline driven, so everything's so instant. So trade war, no trade war, Trump signs a bill, Trump doesn't sign a bill. Everything reacts to the present. And people like you and me have to work out what the headlines are in 12 months' time. And I think they're going to be much more sanguine. And I think next year could be actually pretty okay again. Okay. Maybe not 20% year, but...
All right, so you've inadvertently given us a tip on a local stock, which you don't.
Well, I do. I just think that's an example of something that, if you've got dry powder, I think you should consider looking at.
Is there a foreign stock that you've recently said, I like, or I want more of it?
Well, last month, we had a good month last month. Fund was up 6.2%. I thought I'd just get
Microsoft,
in.
Microsoft.
No, it was Disney, the mouse that roared. I actually got my daughter with me in the studio here today. No, Disney's been...
She's your real advisor when it comes to Disney.
She's a very good stock picker, actually. But Disney, we downloaded Disney Plus, and there it is on my phone. It's been a big success. Disney shares up 18% to an all-time high. But they've also had Frozen 2 with an animated box office record this weekend. And guess what comes up on the 19th of December? Star Wars: The Rise of Skywalker, which will be a huge box office hit.
So, even I'm looking forward to that.
But Disney, it's doing what it should do. The box office doesn't drive profits. It's what happens for the next 10 or 20 years after the box office. In the parks, in the merchandising, in Disney Plus that we stream. So Disney's been a really good one for us, and that's just a stock that not many Australians own, but most people know their product. And that just shows you the power of brands, the power of content, and the power of content with technology.
So therefore, I can say with total confidence, Charlie comes from Disneyland. Charlie Aiken from Aiken Investment Management. Well, guys, this is going to be our most exciting one because we're talking about the media. Is it dangerous? All right, now, Mackie, you sent me a few that you like. We'll kick off with you, and we'll see what Julie gives you the thumbs up or the thumbs down according to her considerations. NEC, Nine Entertainment. What do you reckon?
Nine Entertainment, an interesting one. This is, of course, now the merger of the old Channel 9 television operation and its online operations with the Fairfax Media Group. And this appears to be
They're
the
just
model.
taking the radio network, like Macquarie Radio Network as well, haven't they?
Absolutely.
Yeah.
So this is an interesting build-out of the platforms. When other people are shrinking and specialising or going into new spaces, they seem to be expanding. So it's an open question as to whether or not this model is going to work, but they're certainly having a go at it. And at current prices, it looks okay. It's cheaper it's on a cheaper market multiple. It's on a cheaper PE multiple than the market at around 14 or 15 times next year's earnings.
Yep.
Growth outlook at the moment is a little constrained. In fact, most analysts have it falling. But if they prove this model up, it could turn out to be a real value play. So I'm not firmly behind it, but I can see why investors might be looking at it closely.
The one thing I've always, and I've worked in the media a long time, I've always figured that, like for example, the newspapers weren't good at promoting their people on radio and TV. Like at one stage, Fairfax owned 2UE, and all their journalists were on the ABC. I thought, but I think Hugh Marks is actually working out he has to use all his talent across all his platforms, and that's going to be the interesting thing. Julie, what do you reckon about Nine?
Look, I think it's the best one out of a bad bunch. The problem with this sector is the structural.
Her objectivity is so nasty. Us guys could never be so horrible to Hugh Marks, but a woman, straight anyway.
Well, the problem is the structural challenges that has been facing this sector, not only in Australia but globally, and that's been reflected in the share price. If you have a look at stocks like Nine or Seven West Media, over the last 5 years, share prices are down 70%, if not greater. So the key here is the earnings outlook for the company. And earnings has been in steady decline over at least the last 5 years. And you can very easily separate stocks in the media space into old as well as new media. The old space earnings have been declining and are continuing to be forecast to decline. So that there are stocks like Lion, Seven West Media, Southern Cross Media, as well as Prime. On the new media side, you have Carsales, Domain and REA. And these are areas where you've seen an increase in growth. And over the next couple of years as well, they're forecast to increase earnings by 30 to 45%. So you're seeing this earnings growth continuing to underpin the growth story in the new media stocks, whereas the old media stocks, none of these are forecast to grow earnings over the next couple of years. I think Media, though, is a separate basket.
Okay, we'll get that in a second. But it is interesting, isn't it? You mentioned car sales,
Domain and REA.
And the SEEK fit in that area as well.
Yes.
And these are all areas that used to spend heavily in old media. It's like, in a sense, they've been sucked out and they become like little media businesses in their own right.
Absolutely. And out of the three, Domain is forecast to grow the most over the next 2 years, 43%, which is surprising given that it's the second in this space after REA. And I think REA is forecast to grow about 34%.
It's been a great success story, isn't it?
Yes, absolutely.
Well, Kerry Packer famously described the Sydney Morning Herald classifieds as the rivers of gold, and these businesses effectively diverted those rivers.
Yeah, right. So what do you think about those media ones that Julia likes? Obviously, like Southern Cross.
Southern Cross, interesting proposition.
He gives them a chance to. He's really kind to the old media. Well done, Macca.
Well, they're in radio, Peter. They're heavily invested in radio, and I don't see that lasting another couple of generations. But right now, they're getting advertisers and they're getting plenty of share of the market. So that's money, and I'm happy with that. It's also trading on a much cheaper multiple than many others.
Are you generous with Seven West Media and Prime?
Well, that's an interest. They're obviously playing catch up with the others in trying to expand their network. Interestingly, they're divesting the radio network to Southern Cross, but bringing Prime into it does give them much more reach and opportunity to leverage their content that they're already buying. So I see good sense in it. Whether or not it'll pan out, given their limited exposure in other channels, is another question.
Okay, what's your favourite of the old media? I'll get Julia to comment.
Of the old, I prefer Nine.
Okay, and you, Julia?
I'd agree that Nine has most traction and it's all about advertising.
Okay, let's go to the newer ones like OML, Media. You've brought it up already. Do you like Media?
Look, Media has been punished because it's a cyclical stock. It's all about businesses advertising. And when you see a weak Australian economy, Media does it tough. But it's during those tough times that this stock looks attractive because you know that when the economy turns that you're going to see an uptick in terms of Media. I like the assets that it holds. And I also like the digitalisation of the assets, which means they can very quickly change billboards. And I think that offers opportunities not only in terms of costs and not manually having to put those ads up, but also in terms of offering a premium product so that you can change it with the changing times or the changing weather, or as you get recognition happening as well, as a car drives past, great work driving a Porsche.
Is that what you get, Julia, when you drive your Porsche past?
See what aspirations she has. All right, Macca, what do you got in Media?
Media, I like it a lot, and I like the way it dominates its space. Everybody loves a monopoly, at least from the investment point of view.
Isn't it's the most noticeable from my point of view.
It is by far the largest in the outdoor advertising space, so it basically has the market to itself, I would argue. There are a number of regional players who compete in various parts of Australia, but this one's all over. And like Julia, I think they brought a fresh approach to what has been a very traditional form of advertising, and they've revamped the numbers entirely. Trading on a very modest multiple. I think the growth estimates are weak. I think analysts have misunderstood where the growth comes from, but we do need that cyclical kicker. But once it comes in, I think this one will be
we might have to wait 6 months before the economy looks convincing enough for the share price to actually respond. But I think you guys are right. I think definitely this is going to be hinging on what the economy does. But I think we agree. We should actually have assessment like, we agree. 3 out of 3. That's a buy. All right, REA, you've touched on it already. You said Domain you like more than REA at the moment. Macca?
I was pleasantly surprised when I had a look at these companies today, knowing we're going to have this conversation, because the growth forecasts here are still very strong. And that means when I look at the P ratio compared to the estimated growth, they look quite reasonable. Now, of them, I've found that REA Group is the more expensive. It's getting up towards a growth multiple of around 3 times. But, they also have the superior growth. So
a bit like a CSL, isn't it, in that sense?
And it is hard to buy $100 stock, It's a psychological barrier. There's no reason. You're still putting your $10,000 in or whatever it is you're putting in that stock.
Despite the $1 million they pay you a year working at CMC, $100 a lot of money for you, don't it?
Every cent counts, Peter. Every cent counts.
All right, CAR. Who's CAR for my audience?
Car sales. I mean, this is an interesting one, given that in the new car sales area, we've seen those numbers under quite a lot of pressure. But in terms of car sales strategy, Australia's probably more of a mature market, but it's great to see that they've made acquisitions around the region and around the globe into more immature markets. So taking the expertise that they have in Australia and then making those acquisitions. And I think that's really what's going to be the driver of growth for car sales. Not so much the Australian business, but more the South Korean, the Mexican business that they're really starting to build up.
The driver of growth, that was intentional, was it?
Yeah. We'll give that a tick.
I didn't even realise.
Once again, it's about the growth. And the thing about it is, as they have already got a lot of the infrastructure in place, growth from here drops almost straight through to the bottom line. So very attractive. In a market and in an environment where growth is hard to buy, this is an easy one. And I prefer this one to REA at current share prices.
Okay, now we've been driven by Macca's stocks here. I'm sure you have come with another media stock that you like or dislike.
Oh, well, I went the other way. I just chose a stock that I liked.
Good. Yeah, we like you just freeing with the format because people love what you like.
I started
anyway.
crunching the numbers for these media stocks and in terms of earnings growth and earnings outlook. So I do like stocks which grow and I like strong growth. And with the media companies...
You like ones that don't grow, Macca? No. Okay, we're with you on this.
The media companies, even the most optimistic ones, over the next 2 years, forecast growth of about 43%. EML payments, forecast growth in terms of earnings per share should more than double over the next couple of years. EML payments. So EML is a stock code. They look at things like prepaid cards when it comes to the gaming industry, I guess getting your winnings on a card, or sports betting, or even in the salary packaging area, getting disbursements as well. So look, there's a few growth levers that they have there. They're growing quite strongly, around about 30% in the salary packaging space. Sports betting, if the US starts to allow sports betting in more states, it's a massive growth area. And just recently they made an acquisition of Premium Financial Services over in Europe. It's based out of Ireland, but over in Europe, where it offers white label payment as well as banking services. And that's been growing at more than 30% as well. So a huge growth area. And I think this company, it's a small company, but I think it's primed for growth.
And are you going to talk about this tomorrow at our
And a
conference?
few more. I've got a few more up my sleeve.
Yeah. So if you're doing nothing tomorrow, you come along to City Tats in Sydney. Julie's going to tell you how she picks these hot shot companies that she often comes up with. Guys, thanks very much for joining us, Macca. We'll get you to the next conference. We didn't want to leave you out, but we only have room for one.
Yeah, it's fine. It's fine.
Yeah. Us older people always miss out to younger people.
I'm getting used to it.
Okay. See, these guys will join us next week, of course. Thanks for joining us, Anthony.
Cheers, Peter.
Asia, investing there. Why should people consider giving themselves more exposure to it?
Well, as you know, for Australian investors in particular, this has been a really extraordinary year. 3 interest rate cuts, record low cash rate of only 75 basis points. The RBA might cut again next year and potentially implement quantitative easing. So Australians now more than ever have to look at international opportunities in order to generate the returns that they once enjoyed from defensive assets like cash, like fixed income. And Asia in particular, in a world starved of growth, Asia really shines in terms of some of the long-term structural themes that we're seeing there, and some of these themes that companies can tap into to generate those higher returns for Australian investors.
Okay. Now, I'm obviously going to ask you why Asia, but just in the context of what's been going on, it feels like you're putting forward a contrarian play now, which should and could look really sensible 12 months, 2 years down the track, because we're all worried about the Trump trade war and whether it will be sorted out this side of Christmas or after Christmas. But once it is sorted out, I guess you're arguing Asia's going to be the place to be.
Yeah, I mean, these long-term structural trends that I'm talking about are not going away for decades to come. The region has superior demographics, the region is getting wealthier, consumption habits are changing. They're just tremendous tailwinds. So absent the volatility that you're going to experience from trade tensions or Donald Trump tweets, as we often refer to, these long-term structural themes are significant tailwinds which will likely generate outsized growth going forward, particularly relevant to the sort of expectations that we are forecasting for the developed world. So it is a non-consensus short-term trade, but equally, when you look over the long term, we think that it is a fantastic structural theme to have.
Okay, so what are the, I know you already touched on them, but what are the big growth drivers that people should believe in to justify your position?
Well, let me talk about one example in particular. So what we've seen as these economies have grown in size and opened up to the rest of the world, and as they've developed, people have naturally got wealthier. So they've gone from low income to middle income, for example. So of the next 1 billion people to enter into the global middle class, 90% will be or live in Asia in particular.
That's a great statistic.
Yeah, I mean, they're just huge
It just wins
numbers.
your argument straight away. Like, where do I go with, trying to argue with you on that?
Right, yeah,
Yeah.
So growth is really a reflection of productivity growth and population growth.
Yep.
So as you move up the income scale, the first thing that a low income family will do is change their diets. They'll start consuming protein for the first time. So this is just one theme that I'm talking about, families starting to eat protein for the first time. But there are many, many companies that stand to benefit from that sort of theme right along the agricultural food chain. You start to think about the infrastructure that will be needed to transport livestock to and forth from processing centres. You think about the demand for agricultural machinery for the first time. You think about and one weapon in the trade wars has been China stopping the import of soybeans from the US, for example, in order to feed livestock. Then you go right up the supply chain to the processing, the packaging, the marketing, and then eventually selling in supermarkets. And then, of course, once I buy the protein, how am I going to cook it? Well, for the first time, I buy a saucepan, or I look to buy a microwave, or I look to buy an oven. So there are companies that exist throughout the emerging market world, but in particular in Asia, that stand to benefit from just that one theme in particular. So if you can identify those companies, you stand to have the possibility of generating outsized gains going forward.
Okay. So I know at times you've described to me some classic companies that have benefited from the middle classification, if such a word exists, of China. I think one was a sporting brand.
Yeah.
Why don't you explain that one? Because that's a classic case, isn't it?
Well, I travel around Australia and I meet with financial advisors and I meet clients and I meet the big superannuation and the institutional clients as well. And the first question I ask is, do you know who Li Ning is? And it's very rare that anyone ever knows who he is. And he actually lit the Olympic cauldron in the 2008 Beijing Olympics. So he's our equivalent of Kathy Freeman.
Yeah.
So he started a very successful...
Was he a runner or a basketball
He was a gymnast. He's known as the Prince of Gymnastics. And he was the first Olympic gold medalist for China. He won 3 golds, 2 silver and a bronze in the 1984 Olympics. So he started a sportswear, very successful company that manufactures sportswear equipment and clothing. And that company stands to benefit from millennials in particular, demanding designs that are bespoke to the Chinese consumer in particular. So they incorporate Mandarin symbols and the color red. And increasingly we've found that millennials are demanding the status of Western brands isn't the same for millennials as it was for their parents, for example. So they're more than happy to buy Chinese designed and manufactured goods as opposed to Western designed and Chinese manufactured goods. And that stock is up over 200% over the course of this year on the back of rising revenues and upward profit guidance that we've seen throughout the course of this year.
Is timing important to this market?
Well, I always advocate a long-term holding within emerging markets in particular. So despite the fantastic growth outcomes and the higher returns on offer, it is a more volatile market, meaning you may experience bigger drawdowns than you would experience, say, being invested in the developed world. So we advocate a minimum time horizon of 7-year investment, but really the best way to get the odds on your side of experiencing a positive experience is really to invest for the long term. So whilst I think that there's a short-term tactical opportunity, I also think there's a long-term case for having a structural allocation within our diversified portfolio of assets.
Okay, so I guess your argument also is that if someone goes for an index play for Asia, they will get, I guess, a lot of companies, but you would argue that it's important to pick out the companies that are really best positioned for the eventual comeback of Asia.
Yeah, I mean, these themes that I'm talking about, demographics, rising income, increasing consumption, they're not new. They've been going on for 30 years, but investors have been frustrated in that it's actually, if you look at an index level, it's actually been more beneficial to be invested in the developed world equity markets as opposed to the emerging or Asian equity markets. And the reason for that is I have a problem with how these indices are constructed in that they're largely backward looking. They favour the slower growing companies that are very large, that exist in the slower growing regions of Asia like South Korea or Taiwan, for example. And they exclude many of the fastest growing companies, the winners of tomorrow. So an index play really rewards the winners of yesterday, but they won't necessarily be the winners of tomorrow, particularly as these economies, their growth profile changes from an export-driven economy to one which is more internally demand-driven or consumption-led, for example.
Okay, in the wide world of investing, not the wide world of sport, but investing is a sport, there are a lot of players. What's your competitive advantage? What's Fidelity's competitive advantage for people to support you?
So we're a very large active investment manager, meaning that we're benchmark agnostic. We don't pay too much attention to the benchmark. So if you invest in one of our funds that tends to have high conviction, a low number of stocks that we invest in, we have a very low overlap with the index, which means we have a high level of active money. And we're very diversified. We're well diversified. So we generally experience a better drawdown than the market. So if the market falls, we tend to fall by less over the course of time, being backward looking. But our main competitive advantage is being a large global active investment manager. We have investment resources and analysts based all over the emerging world, and particularly in Asia. So we have a very large office in Hong Kong. We have analysts in Singapore. We have the largest research team based in Bombay in India. So it's so important that when you are investing in a region like emerging markets or Asia, that you do your homework, that you do your fundamental bottom-up analysis, that you consider who the auditor is, and that you have a strong background in doing that bottom-up research in order to identify those winners that I've spoken about over the course of over time.
Okay. I guess the last question I should ask you, Anthony, is, you know, there are local Australian pickers of Asian stocks. What's the big advantage you think of having a fund manager who's actually residing in Asia and making the decisions?
Well, it's so important. So we spoke a little bit about Li Ning earlier. You know, household name in an economy or a country like China with 1.2 billion people, but in Australia, relatively unknown. So another example of a local theme that Australians may not know about is the world's most popular spirit, for example. So it's not vodka, it's not whiskey, it's not bourbon, it's a spirit called Baijiu. So we invest in a company called Kwai Chow Motai, which is a Baijiu producer. And
not Moutai.
Huge demand in China for this spirit, which is often drunk at family celebrations like weddings or events like Chinese New Year, for example. And we've seen this company generate returns of over 100% this year. So this is the world's most popular spirit. And I would suggest that a lot of Australians don't actually know. So in tapping into that rising wealth, rising demand, rising consumption story, we've been able to pick a company and invest in its shares that has generated outsized returns for our fund over the course of this 12 months. So that's a case of where we've been local, we see the local trends, we've done our homework, we've met with company management, we've understand the risks around investing and the potential outlook for the business in particular, and we've made an investment and we've generated good returns on behalf of our investors in our fund.
Okay. Thanks for joining us, Anthony.
Thanks, Peter.
That's Anthony Doyle of Fidelity.